let me give you a quick overview of FTG. First of all, going to make some forward-looking statements. Be aware. Let me describe the company. So our market focus, 100% aerospace and defense electronics. That is where we're focused. That is what we do. Within that, we have two product offerings. We do cockpit products, basically anything a pilot will interact with in an aircraft cockpit, from relatively simple products to more complex assemblies. The other part of our business, we do printed circuit boards. We do the bare board. We're not doing assembly, but again, 100% focused in aerospace and defense. A little bit about FTG today. As of today, we have 9 sites. You see 2 of them flashing. Those 2 that are flashing are actually 2 acquisitions we just did the end of April this year, so they're new sites to FTG. Of the 9 sites, we have 2 in Canada, 1 doing cockpit products, 1 doing circuit boards. We have 5 in the US, and 2 in China. Again, in China, 1 doing circuit boards, 1 doing cockpit products. The circuit board plant in China is a joint venture. Last year's sales, $90 million. Our Q3 results for this year are coming out tonight, but market's closed, so I'll share a few bits of data. As of the end of third quarter this year, we're at $95 million in sales, 1 quarter to go. Total employees at the end of last year was 475. Total employees as of today, about 700, and 23.9 million shares outstanding. Largest shareholder is Oak West at about 20%, followed by me at about 11%, and then TD Asset Management at around 10%. We have 4 strategic priorities or strategic initiatives in the company. This is really just to drive our financial results, to drive our return for shareholders. First one is operating performance. And really this is just focusing on how to drive margins, how to improve the business through operational performance. Some examples of what we're doing in this area. We have something called the FTG operating system. All we're trying to do with this, it's not exciting, but when you're a manufacturer, you got to stay focused on the nuts and bolts of the business. We're trying to have consistent performance across all sites, trying to have standardization in the way we do things, try to make sure we leverage the best practices either from within the company, from outside the company, wherever we get them, to drive improved results, drive improved on-time delivery, drive improved quality, drive improved productivity. Also on that, and because I had to email this in, I couldn't include the actual videos, but we're investing in automation in the business. This is 3 different robotic systems we put in place in one of our plants in Toronto. It's a way to drive productivity in the business. Wherever we put in things like automation, this is kind of the high-end, more exciting part of it. It has never caused us to reduce staff. It has caused us to be able to produce more, grow our revenue with the existing staff we have. So those are a couple examples on operating performance. Next one around growth. And the reason growth is important to us is this slide. So on the left-hand side, if you look at our overall costs, about 30% of our costs are fixed, 70% are variable. But if I can grow my top line within my existing facilities, I add no fixed costs. That drives my margins up. So the way I've described it in a very simple method is top line drives bottom line at FTG, or plant utilization matters. So if I can improve my plant utilization, I can expand my margins significantly. The other, talking about growth, so aerospace and defense, particularly aerospace, was not a happy place to be during the pandemic. Aerospace went to zero. The fact that we were diversified across more than just commercial aerospace, the fact that we were involved in defense meant, our revenues didn't go to zero. But, this is an example of, this is a number of people through USA checkpoint, there are TSA checkpoints in the US. You can see in 2020, they went almost to zero, but they're basically back to where they were pre-pandemic levels now. So that's good news for our business. We're definitely coming out, or we're out of the pandemic. We're out of the impact of the pandemic. One measure of growth for the industry. The one that matters to me more is commercial aircraft delivery. So this is just looking at Airbus and Boeing, and they're certainly the big 2. There are other aircraft manufacturers such as Bombardier, but these 2, The orange bar being Boeing, so you can see where they were pre-pandemic. Boeing had a double impact. There was a pandemic, they had some challenges with the 737 aircraft, so their production rates really dropped, and it really hurt the industry. Airbus, less so. Their 2019, they hit a high. They dropped off during the pandemic, but you can see it's almost back to pre-pandemic levels now. So again, the industry is back to where it was. And if you look forward from this, both Boeing and Airbus are predicting significant production rate increases over the next 2 years to get to higher than where they were pre-pandemic levels. And the last thing I want to talk about in terms, the next thing I want to talk about in terms of growth initiatives, this is what I described, this kind of the 6 key things we look at within FTG to drive the growth in our business. First one is just the overall market and industry growth. So I already talked about that. Market is recovering, market is strong right now. Next one, the best way to change your market share is get involved in new programs. So we put a lot of effort into understanding what new programs are coming out in the future and trying to win content on them. So when they go into production, we get a new revenue stream. And the one thing I would say in aerospace and defense is revenue is very sticky. Once you're the qualified supplier, you can be that supplier for decades, as long as that plane's in production. Third thing on this chart, operational excellence. All my customers are the big multinational, multi-billion-dollar aerospace and defense companies. They all have sophisticated supply chain organizations. They all say the same thing. If you perform, you get more work. If you don't perform, you don't get more work. So we put a lot of effort into performing across the company. And that goes back to what I talked about in terms of the FTG operating system. Fourth item, new technology. You need to have the technology available to get involved in the new platforms. What we do is electronics. Every time something new gets developed in electronics, people are trying to find a way to make it smaller, make it more compact, use less power. You need to be able to support these new technologies to get on the new programs. Fifth item, globalization. All my customers are global. The aerospace industry is global. They all sell globally around the world. They need a global supply chain. And the fact that I can now offer solutions from Canada or the US or China is an important factor for our growth. And finally, growth initiative for us is acquisitions. One other example in terms of the way to grow your business is technology. This is for my cockpit product business. But 20 years ago when I went to FTG, we were supplying the bottom item on this chart, backlit panels. Relatively low technology product, hundreds of dollars a piece. If you did all the panels in an aircraft cockpit, maybe you got a few $1,000s. Today, most of our new wins are at the top of this chart, electronic assemblies. We're doing box level assemblies. It's still got the front panel on it, but it's got electronics inside. It might have software included. And I've moved my content per aircraft from a few $1,000s to potentially $50,000. So an important way for us to grow our revenue stream. Moving on to the third item, market positioning. So we put a lot of effort into benchmarking different people in the industry, understanding their margins and understanding what's driving their margins. And the reason we do this is we want to make sure we're investing our time and our effort into high margin business. This is a little kind of summary of some of the conclusions we found. But if you look at the 4 different segments that I've identified here, there's defense production, there's aerospace production, simulation market, and then aftermarket. And I'm just going to talk about margins on this, but defense production typically has lower margins. And it's government contracting. There's a million rules in place in terms of what you're allowed to charge for the product you manufacture. It's not bad margins, but it's lower than some of the other segments. The aerospace production, it's a commercial business. It is driven by commercial priorities. It has better margins. Simulation has higher margins than aerospace production, but has lower production rates. And then lastly, aftermarket and spares has the highest margin. It's a different type of business, but it's certainly, when I benchmark some of the other companies in the industry, the guys with the best margins are the guys with some or more aftermarket activity within their revenue stream. Last item, acquisitions. So the reason, I've always said acquisition is an important part of growing FTG. I'm happy to grow organically, but I'm also happy to grow through acquisitions. I think, for us to achieve our objectives, I need to be doing both. When I look at acquisitions, there's a number of reasons to do it. I'm not doing it just to drive revenue growth. I'm doing it to, in some cases, add new technology, add new capabilities. In some cases, I'm doing it to expand geographically. In some cases, I'm doing it to add capacity. So I've done all of these in the past. There's many, different reasons and different benefits from doing them. But my first priority is I got to be addressing one or more of these items. A history or a timeline of some acquisitions. So this is a combination of companies we've acquired and facilities we've set up. In some cases, we've done greenfield setups. Our cockpit product business in China is a greenfield. We started with nothing, big empty building, and grew the business. And then lastly, hopefully it comes in. So this year we just added 2 acquisitions in April of this year, both of them in the US. We acquired a company called IMI. It's in Massachusetts. It's a circuit board manufacturer. It's focused in a very specialty area of circuit boards called RF circuit boards. But it's something that we see as a growth market segment, so it gives us a base on which we can build. Relatively small acquisition, $3 or $4 million in sales. Bigger one, we acquired a company called Holiday Circuits. It's based in Minnesota. Again, 100% focused on aerospace and defense. It was someone I've competed with forever. They had a great reputation in the industry. I reached out to them 1,000 times over the last decade to see if they were interested in selling. And finally, they agreed they were. They ran a process. We were successful in it. So we've just added them into FTG in April. Much bigger deal. They were doing $30 million US in revenue pre-pandemic. Like us, they had been hurt during the pandemic, so 30 had become low 20s. But for sure, with the industry recovering, we see them going back to 30 million in sales. The other important thing for me when I'm looking at acquisitions, so it shows how we try to position the different sites, first on our circuit side, then on aerospace or cockpit products. I'm only going to talk about the circuit board side. So, there's commercial aerospace, there's defense market segments, and then there's different technologies. And so if you look at how we have the existing sites and see where they're positioned, you can see there's some areas where we're not fully covered. But through the acquisitions, the things that are most important to me is, first of all, filling in some of the gaps we have. So if you look at Holiday Circuits, very similar capability to what we're doing in Circuits Toronto, but they're in the US. And they can address the defense market better from the US than we get addressed from Toronto. So now, both sites do high density interconnect, high technology circuit boards. I can now address fully both the commercial aerospace and the defense market. And then IMI, is a specialty circuit board manufacturer. As I said, they're doing RF circuit boards, focused very much on the defense side of things. So again, I'm filling in my ability to be the complete one-stop shop for my customers, which is important to them. All my customers, as I said, are the big multinational aerospace companies, the Raytheons, the Honeywell Aerospace, the GE Aviation. They all have this dream to simplify their supply chain, to spend more with fewer suppliers. If you offer the widest range solution, you can be one of the guys they consolidate into. I'll give you one example of what's happened with us and Collins Aerospace over the last decade or so. If you went back 10 years, Collins had 60 circuit board manufacturers. Their goal was to move that to 6. We were definitely one of the 60. We were doing a couple of $1 million a year of circuit boards with Collins Aerospace. We were selected as one of the 6 they would like to consolidate into. We're now doing close to $15 million a year in revenue with them as a result of that. But it's because we had the global solution, because we had the complete product offering, we were one of the people they selected. Talking about the acquisition, so the Holiday acquisitions, a lot of words on this slide, and I apologize, but what is Holiday? Again, first and foremost, it's high-tech circuit boards, high-end product, focused on aerospace and defense. They had been our number one competitor and our number one acquisition target for a decade. They had some great customers in Honeywell, BAE, L3 Harris, had a big facility in Minnesota, 110,000 square feet. They had peaked at 31 million in sales, but had dropped off during the pandemic. And our purchase price, base price, 17.6 million, with a possible earnout if they get back to their pre-pandemic levels of another 4.4 million. But we valued it about 4.5 times EBITDA. What do we need to do to make this happen? What are the key integration activities? First of all, we're going to operate it as is, where is. That's the good news. It's an easier integration process than some of the other acquisitions we've done. I'm now saying bring in strong operations management. They had 3 people really running the business, the 2 owners and a VP operation. The 2 owners were not staying post-acquisition. The VP operation, a month after we acquired it, had some health issues and went home and stayed home. So all of a sudden, the 3 guys running it were gone. That was a problem for me in Q3. My Q3 was June, July, and August. So June and July were a little bit tough. But we have found, and we brought back a guy who used to work for FTG a few years ago who had gone into semi-retirement. He agreed to come back and help me out. As of August, he took over operations at this site, and he ramped their production about 30% in his first month there. So I'm feeling better about this now, but that's why I say bring in some strong operation management. The guy I brought in for sure is not my long-term solution, but he now gives me time to find the right guy for the long term. We needed to add some staff. They had been 190 people. They dropped to 150 during the pandemic. As of today, they're about 170. We had identified during due diligence some significant cost savings on materials where they were paying more than what FTG had been paying suppliers. So we're working to take advantage of those cost savings. In some cases, we need customer approvals to make those changes, so it doesn't happen overnight. But there's some good cost savings we're working on. And we believe we need to be a little bit more aggressive on pricing than they had been. That there's certainly been inflation in the last few years. It looked like they had not really been adjusting their pricing to align up with their cost increases, but we are working to do that, and some of that's already been achieved as of this point. And we can take advantage of some U.S. tax losses to shield their future earnings, and we take advantage of our sales team. We have a sales team primarily based in the U.S. of 8 guys. Holiday Circuits had 1 guy. So we can leverage that sales team to grow them and diversify their customer base going forward. So we do anticipate a partial recovery this year, and we do believe that they can get back to pre-pandemic levels by next year. Just a few pictures. So this is what Holiday Circuits looks like in the summer. They are in Minnesota, so this is what that looks like in the winter. And man, Minnesota's cold in the winter. I might be from Canada, but I did not like it there in February. Inside, might not be interesting to you guys, but I like this stuff. They have a great equipment set. Just, a few pictures of some of the equipment they have in the plant. It is well capitalized, it's new, it's modern, it's good capabilities. We have a great new plant as a result of this acquisition. Just a few examples of the equipment set they have there. Moving on to IMI, as I said earlier, focused on RF circuit boards, focused on the defense market. Their largest customer is a company called Mercury Systems, which is kind of a ruggedized computers manufacturer for the defense industry in the U.S. It's a new customer for FTG, which we like. Mercury certainly buys more than just RF circuit boards, so we're hoping we can leverage this relationship into new opportunities for other FTG site. A bit smaller at 30,000 square feet. Pretty consistent sales over the last 5 years, not really growing. They were undercapitalized. They were not in a position to grow, but they're also not impacted by the pandemic. And we ended up with a great price. We paid between 2 and 3 times EBITDA on this. So it's easy for this to be an accretive, good opportunity to grow profitability at FTG. Key integration activities, again, operated as is, where is. The current guy who owns it, his goal is to retire, but he's agreed to stay on for a year through the transition and to make a little bit of CapEx investment in this year to improve the facility and to add some capacity. As I said, they were capital constrained, so we can help address that. We're not talking material numbers. This might be $500,000 of investment to do what they need to do, but definitely improve the business. Again, leverage our U.S. tax losses, and then leverage our sales team. I said Holiday had one sales guy, IMI has none. And if I looked at their customer base, virtually every customer was within 100 miles of the plant, and it was really the owner, as far as he could drive to get to a customer was their customer base. So we can definitely expand that in the coming months. And again, a handful of pictures, pretty well capitalized for a small facility. Just again, a few examples of interesting circuit board manufacturing equipment. And I guess one of these is just, a very different type of product. This is one panel. They do product that's typically very small. They'll make 1,000 circuit boards on a panel, whereas in a typical, what I would see in other FTG plants, it might be 2 or 5 on a panel, not 1,000. But specialized product, but also great margins, great opportunity. A little bit on financials, capital allocation, cash management. First of all, capital allocation. We're very specific on how we allocate capital. Our first priority in the company is to reinvest in the business, to ramp throughput, to drive technology. We have put together a little bit of data over the last 5 years, including acquisitions. So this is everything on the page, but we have invested $70 million in the business. 100% of that came from operations. So we have been a great cash generating business and then reinvested it to grow either through the organic growth or through corporate development activities. As I said, IMI and Holiday, we spent $25 million on those 2 acquisitions in April. At the end of those, our net debt was about $6 million. And within that, about 4 of it was interest-free government funding. So, we have a great balance sheet. I believe we can pay down that existing debt pretty quickly. And then lastly, we do have an NCIB in place. We had one last year to buy up to 5% of our stock. We have one again this year, which just got going again in August. But we have now purchased close to, I think it's the end of September, close to about $600,000 in shares. It's not my priority. It's number 3 on my list, but it is something we're comfortable with. We're kind of doing the opposite. We're not diluting our share base. If anything, we are anti-diluting. We're shrinking our number of shares outstanding to help drive earnings growth on a per share basis. And so we continue to deploy our cash. Our goal is to drive profitability and drive earnings per share, drive returns for shareholder. Financial performance, this is revenue per quarter over the last couple of years. 21 was really the last year we were impacted by the pandemic. Q1 in 21, we were sub 20 million in sales. It grows incrementally. My demand grew faster than this. I was, working hard to ramp up to support the demand. You can see in Q2, you start to see Q2 this year, Q2 23, you start to see the benefit of the acquisitions. Q3 this year, which is my results that are coming out any moment now, but you see them first. World record sales in a quarter, we were 36.6 million in sales, closing in on the double from where we were a couple of years ago. So, the recovery from the pandemic is great. The production rate growth at Boeing and Airbus is great. This, solid, stable defense spending, everything is going in the right direction for us right now to really drive our revenue growth. And then if I kind of overlay, and this is adjusted, not what I reported, not really, my only adjustment is I took out government support. During the pandemic, we were world-class at getting government support to stay alive, to survive the pandemic, to survive the revenue drop, and to be able to retain our staff. We did no layoffs during the pandemic. But EBITDA at early 21 was somewhere around 0. EBITDA in the last 2 quarters has been above $5 million a quarter. So things have really turned around for us. And again, from all my experience from what I see at FTG, we are top line drives bottom line. If we can continue to drive revenue up, we can continue to drive EBITDA up, earnings up as we go forward. And then just on the balance sheet, the green bars working capital has been pretty stable, a little bit of growth, and some growth. This year, we've been building inventories, which has not been my favorite thing to do, but as we've ramped production, we've definitely had to invest in some inventories. I'm hoping we can start to bring that down a little bit. And then the bottom gold and red, and I guess the last bar should actually be red, but is cash or debt, net cash or net debt on the balance sheet. Back in 2016, we did a couple of acquisitions, so we had some debt. We paid it off. We generated a big cash balance. And this year we invested that into the acquisitions. And again, at the end of our second quarter, we were about $6 million in net debt in the business. But again, pretty solid, stable revenue stream. And lastly, in terms of the stock performance, this is just over the last 12 months. So from before we announced the acquisitions to post-announcement, our stock is up about 65%. We'd spiked a little bit higher. I think we're up over 100%, and then it dropped off a little bit over the last few months. And I went and did a little bit of research after the keynote speaker this morning, but if you looked at FTG over the last 12 years, it is almost exactly 1,000% increase from where we were 10 years ago. So we have driven the business in the right direction. We've had some great results, and it has been reflected in our share price. And with that, I thank you all for your attention.